Welcome, everyone, to the Trust the Plan podcast. I'm Nick.
And I'm Preston.
And Preston, this is the Feel Good edition.
It is.
Yes, it is. So, spring has sprung. What are you doing to take advantage of it?
Really, the thing I'm looking into right now is Tigers games. What are some good games to go to, get out and enjoy the sun, root on the hometown team?
I haven't thought about that. Interesting. Maybe I need to do the same thing.
Yeah.
I went to one game last year. It was the last game of the season, and they were sold out.
Yeah.
Right?
Yeah.
And it was a $5 ticket, but they were going for $100.
I believe it. I had partial season tickets last year. It was like a 20-game package or something. And I sold my tickets to the last game of the year, and I paid like $20 a ticket. It was a nice outfield seat, and I sold it for like $120.
Nice.
Yeah.
Nice. All right, so what are we talking about today, Preston? We have a tax example, a tax planning situation, a case study that we're going to go through where if you have, basically a chance to have early retirement. Well, if you want to have a chance for early retirement, you have to have money usually set aside outside your 401, outside your IRA, right, because of taxes.
Right,
and the 59.5 rule and all that. And so the key for early retirement in this case would be having a big brokerage account or a big bank balance, basically money that you can access without having to tap into your retirement accounts early.
right, exactly. And the issue with that could be, well, really always is managing the taxes out of those accounts because you don't get the tax delay. So as you start selling things, you start incurring tax.
That's right. Okay. And so the other nice thing about having early retirement and being able to live on a brokerage account is being able to look at Roth conversions, to be able to look at Obamacare subsidies, to be able to take advantage of what the tax code offers. So what we have here is a case study where someone is a high-powered earner. They save a bunch of money throughout their life, maxing out their 401, adding to their brokerage account, so they get to that early retirement age of 55. Okay? The problem is, right now there's no pension, there's no Social Security, there's no health care. So how exactly are we going to retire?
Right.
The good thing is, in this example, there's no mortgage anymore. So there's no debt. Kids are kind of out of the house, right? But we have a high cost of living, and our brokerage account, which is very large, has huge capital gains because they've been growing it for 10 plus years. So we're going to try and walk through this and show you how it would work.
Yeah, sounds exciting.
All right. So why don't you lead us through the software here, Preston, since you're the holistic plan expert.
Yeah, so if you're watching on YouTube, good for you because you can actually see what we're looking at here on the screen behind us. But this is our tax software where we can run some analysis on, if we do X, what happens in terms of taxes. So you'll see kind of at the top here, we've got how much are they going to make through wages, regular W-2, and the answer is 0. They have retired early and they're not going to show any taxes. They're also not going to take any IRA distributions because they're younger than 59 and a half. But what they are going to do is they're going to start cashing in some of this stock from this brokerage account, which is going to cause some long-term capital gains. So in this example, we said, what if they cash in a whole bunch of it and they end up showing $250,000 of long-term capital gains? What happens? And that's really their entire scenario. Every number is 0 except for long-term capital gains, $250,000. So you see they've got total income is the $250,000. Then they get the standard deduction, which this year is $15,000 if you're single, $30,000 if you're married.
And this is the example here is a single person.
Right.
Yeah.
So the example here is a single person. They get the $15,000 standard deduction. So their taxable income is $235,000. They get long-term capital gains rates, of course, on that. So their marginal bracket here is they're able to stay in the 10% marginal bracket, but their effective tax rate, which is this number right here, that's 12.7%. So that's when you add up all of the tax they're going to pay divided by how much income they showed, what percentage did they pay in tax?
And so some of the capital gains were free, some of the capital gains were 15%, and some of them were 20%.
Right.
But it all averages out to 12.7. So the total tax is $30,000 on the $250,000, which is the 12.7%.
Yep.
Okay, so the effective tax on ordinary income is 18%. The marginal bracket is 10%. What does that exactly mean now?
Yeah, so the marginal bracket is, if you're just purely looking at the chart the IRS publishes of if you make this much, you're in this tax bracket. In this example, they'd be in the 10% bracket because right now they're making zero. So the next dollar they earn, they'd technically be in the 10%. But their effective tax on the next dollar is actually 18%. And it's because for every dollar they make, they would be pushing more of the long-term capital gains into a higher capital gains rate.
Interesting. Okay, so they're able to have a very low tax rate with a very large capital gain realized situation here. Now, what if we play with it a little bit and say, hey, since we're in this 10% marginal rate, could we take advantage of an IRA withdrawal or a Roth conversion at a low rate?
Yeah. Yeah, and that's another cool piece of this software is we can start running some calculations and say, if we add X dollars of income, what happens?
So if I were this person, I would be thinking about a Roth conversion because they have a large pre-tax balance of a couple million. What if we wanted to get some of that into Roth?
Right. And so this chart here is going to show us as you go out and earn more income, how much do you actually pay in tax? So even though this person's in the 10% marginal tax rate, they actually, for like we were just saying, sorry, I zoomed in. For the next dollar that they earn, they're actually going to be paying that 18%, and it's even going to climb higher. Yeah, there we go. So you see, as they start to earn more, they're paying the 18%, and then as they cross a certain threshold, they even jump up way higher. They're closer to 30% effective rate, and it's because more of the long-term capital gains gets taxed at a higher rate. Also, the income starts to get taxed at a higher marginal rate, and then we've got this net investment income tax.
All right, but so far they've shown zero ordinary income, okay? And we can see here when they have low ordinary income, the blue, which is the tax on the ordinary income, is still zero. Let's put in a $10,000 conversion and see what it tells us.
Yeah. So again, in the base example, we've got $30,000 as the total tax. And so now we're going to plug in what if we add a $10,000 Roth conversion. And actually, it even tells us right here, the incremental tax of adding that $10,000 is $1,880, an increased tax at 18.8%.
Okay, now this is interesting because if they did not have any capital gains and they were living off bank money, right? Which is not taxable at all because it's just your money coming back, no capital gains.
Right.
This $10,000 conversion would be free.
Right. They get it in the standard deduction.
Yeah. And in this case, it's 18.8 because it's creating more tax on the capital gains, which are already baked in, but it's changing
the rate at which it's taxed.
Yes.
Yeah.
Thank you. Okay. What if we go back to the other tab, the chart? Yep. All right. And so 50,000 would have us still in the 12% bracket. Okay. Let's go big. Let's do a $50,000 conversion and see if we still stay, close to that 18.8%.
Okay, so here, if you're looking at the screen, we added in a $50,000 Roth conversion, and the tax due as a result of doing that is a little over $13,000, which means your effective rate on that is just shy of 27%.
Right. So that's kind of pushing. In my opinion, it's kind of pushing the limit of pain, right? 27%. But this person, literally, when they're 54. They're maxing out their pre-tax 401k for $31,000. Okay, so that $31,000 was deducted at 37% because they're in the top bracket, and then the next year they're able to turn around and pull it out in the 27% marginal rate.
Yeah, it's a way to ease the emotional pain for sure. Is knowing that hey, I just wrote it off at 37, and now I get to do it at 27.
Yeah. Now, if it wasn't that a capital gain situation, they would be able to do this 50,000 for less than 12% because some of it was free, some of it would be at 12%. So it would be pretty cheap. Let's do another edit. Let's go back to the base plan here, and let's say it's a smaller capital gain than 250,000. Something more reasonable. Because even if this person is living off of 250,000, they're not going to necessarily harvest all of those gains in 1 year.
Right.
So maybe it's 100,000. Let's go with 100,000 of capital gains, which still is a lot in terms of capital gains. And now look at that conversion of 50,000. Or let's do 10 and then 50. So this is 100,000 of capital gains, a Roth conversion of 10,000. We're paying 15%. So basically, that's just capital gains.
Yeah, that's just the capital gains rate.
Yeah. Okay. But it's the lower capital gains rate.
Right.
We're not into the Medicare extra tax, and we're not into the higher 20% capital gains rate. Now let's do 50. Okay, now we pushed up to 23. So our ordinary bracket is still only 12? Ordinary income bracket after?
Yeah.
Okay, but now more of the capital gains pushed up from 15 to 20, and we end up overall at 22.9. It's so technical.
Right.
Come on.
Yeah. It's so easy to just look at the IRS's published charts and say, I'm going to be in the 10, I'm going to be in the 12, but there's so many complicated variables that go into all this.
This capital gains issue is very similar to what we deal with Social Security,
Right.
with the tax torpedo, where it's not so simple that you're just in the 12% bracket, because as you convert or as you create more income for yourself, more of the Social Security becomes taxable. It's a parallel with the capital gains conversation. So everyone's situation is a little bit different, but the idea here is to illustrate how we can try and manipulate your taxes, not do anything that's not allowed, but manipulate your taxes this year versus next year and see if we can, have a little arbitrage by deducting at a higher rate, pulling out at a low rate. And if you're able to do even small conversions every year, in this person's case, perhaps for 10 years, maybe even 15 years of conversions, now all of a sudden, when you look at your pre-tax versus Roth balances, they're more even. When you get to the required minimum distribution age, they're much more reasonable, and you're able to manage your lifetime income tax rate versus just getting clobbered in the later years due to the required minimum distributions. Any closing thoughts?
Closing thought is just simple. Well, simple that it's not simple to try to calculate all these things. There's way too much that goes into all of it.
For sure. So if you would like to have a tax planning session with us, please reach out to us at peakwm.com. Don't forget to like and subscribe and share with your friends. Thank you.